Aaron, Greg, welcome to the show. So great to have you on it. We've been trying to do this for a little bit, so I'm really happy that we could make this together on a manic Monday. Aaron, let me start with you. How would you describe the current state of the MSP market? And what are some of the key trends you're observing in this space?
It's been a busy year for us at IT Valuations. Obviously, we work with clients in a variety of ways, but when I think specifically about transactions, the velocity has actually been pretty steady. We will probably do more transactions this year than we have done in any year in our history, and we have a lot of sellers going to market. I think that's largely due to the fact there's been some economic growth and been good organic growth in this space. And so I think sellers are looking to capitalize off of that growth, that economic growth. And so the velocity has been steady. I would say that buyers of MSPs specifically have more options. There's a higher level of scrutiny. There's less margin for error when considering different MSPs. And so those who go to market have got to have their financials together, have got to be able to tell and craft a story behind what the numbers are saying, and those who do are still able to capture a pretty healthy multiple.
Yeah. Aaron, on this, do you think that there is a broader variety of buyers this year, or do you see any trends in that direction?
I think what we are seeing, and this has been a continuation probably over the last 6 to 12 months, but in years past, private equity may not have touched something below $1 million in EBITDA, and now we're seeing as the number of those firms decrease, or as some of them are gobbled up by private equity, we're now seeing private equity dip into that $750,000, $500,000 of EBITDA.
Tell us a little bit about the range of services that IT Valuations provides for MSPs.
So we obviously do what's in our name. We do valuations of IT companies, and so we have a couple different options within the valuation space. For those who are looking to get a one-time valuation, maybe to assess the size of their the value of their business before maybe going to market, or maybe you're a buyer looking to assess the value of a business you're looking to acquire, a one-time calculation of value is an option. What we are seeing in a little bit more popularity is our valuations as a service. Again, same concept, and Greg will unpack the methodology later, but it's an annual evaluation with 3 quarterly updates that really track value creation quarter over quarter, year over year. And so as part of that, you get access to a 24/7 dashboard as well as your scores on 24 different drivers of value. And so you can see how adjusting and correcting some of those drivers of value over time can actually lead to a growth in your valuation. So valuations are normally the start of everything we do. So whether you're working with us on a buy-side project where you're looking to acquire another MSP, maybe you want to sell, we'll start with that valuation process. But as I said, we'll do buy-side advisory, sell-side advisory work. We'll do typically a couple mergers a year, mergers of equals. And then we also have launched within the last 6 months IT CPA. And Greg can speak to that because he's the managing partner of IT CPA. So in some ways, it's his brainchild, but I'll let Greg talk about that.
Yeah, so CPA compliance consulting advisory firm that we launched in technically legally back in March, but really went to market in July, and really just providing IT service companies and their owners a strategic tax consultant that is really providing kind of a perspective on and an ear to the marketplace from an M&A standpoint, and making sure that the tax structure of their business aligns with their M&A goals and objectives, their personal wealth target goals and objectives, and really just calling into question considerations that maybe their current CPA is not asking them, because it's turned into such a transactional relationship of just getting the tax return done.
So one of my favorite stories was a transaction we did earlier this year, in the first half of the year, and it was a great company, strong operational maturity. The owners had really worked very hard to grow the company and make it profitable, and great group of employees, great group of clients, and actually had thought about going to market on their own, and actually had solicited several offers. And I think we're pretty close to accepting one in particular, but kind of pumped the brakes a little bit and thought, okay, we get one shot at this. Why not just get a valuation to see how things go? And the evaluation showed that their value was, significantly higher, 50-60% higher than what they had actually already received offers for. And so they engaged us then with sell-side work. And what's interesting about that particular story too is they didn't take the highest offer. All the offers were within an acceptable range, but they took the offer they felt was best for for them as the owners, for their customers, and for their people. And those are the kinds of stories that are fun. They got more than they probably thought they'd ever get. It all started with evaluation.
One of the things that I'm aware of, and that, I think it was Aaron who mentioned in the call, that you have this valuation approach, which is 24 company specific factor approach. Tell us a little bit about what that approach is, and what are some of the most important factors that you think drive valuation?
Yeah, so we at IT Valuations are certified valuation analysts, or CVAs. So we abide by the National Association of Certified Valuation Analysts, NACVA, and their standards for calculation of value. And what those standards basically are is you have to pick an approach, either income, market, or asset-based approach. And we picked income for our calculations of value. So we're capitalizing historical cash flows and then capitalizing or discounting future cash flows, and then kind of coming up with what is the present value of all of those cash flows in kind of a blended or averaged mechanism that makes sense relative to the market. But in addition to that, we also then do it under a given set of assumptions that are agreed upon with the owner. And so part of those agreed upon set of assumptions are, hey, we want to understand your business and have you answer a 42-question questionnaire so that we can identify one of the components of our calculation, which is company-specific risk. And within that company-specific risk score, we have 16 risk factors that roll up into that 1 percentage point, which impacts the entire valuation. And so when we're looking at some of those 16 company-specific risk factors, we're looking at like owner dependencies. We're looking at like contracts, the length of them, or what are the terms on them? What is the recurring revenue mix of the company? What's the customer concentration? Are they pretty concentrated in one or two or three really large customers, or are they pretty well, diverse and spread? What is their EBITDA volatility? Are they going from super profitable to not profitable year over year? And so we take into account all these risk factors in a weighted fashion and weight the ones that have a greater degree of risk to a potential buyer that, as a heavier weight than the ones that don't. And therefore put those, lay those out and basically get a risk score between 1 and 10% as a percentage. And then that gets layered into the whole discount rate, capitalization rate of the valuation piece. But in addition to those 16 factors, our tool is also looking at a market-based approach in addition to that income-based approach. So we're really trying to look at what is the market doing, what are buyers paying, what are buyers looking at in terms of additional risk factors when they're going through due diligence. So that's why in addition to those 16 risk factors that directly go in the calculation, we have 8 marketability factors that we look at, which are really things that will be uncovered during due diligence. You think about things like growth potential, go-to-market strategy, the management team's effectiveness and operational maturity, transaction readiness. Do they have the processes documented and things are able to be transferred to the potential buyer? And so we're trying to look beneath the surface at those risk factors to really identify, is this company truly worth a fill-in-the-blank EBITDA multiple or fill-in-the-blank revenue multiple relative to what other companies of a similar size have sold for in the marketplace? So we always allow the owner the opportunity to present their forecast to us as part of the valuation process. Now, realistically, owners have about a 6 to 18 month lens on what they can realistically predict. So what we do in a lot of valuations is we allow them the kind of the latitude to establish with support that first year's growth rate after the valuation date, but then years 2 through 5, because we're collecting 5 years on this forecast, years 2 through 5, we typically regress to the mean. And the mean being either the average in the MSP space, which the MSP space on average, according to IBIS World Report, is about a 10% year over year growth. And so we either regress to that or we regress to what is the historical average growth rate for that company.
I am always curious about this question around customer concentration. How do you deal with that?
Yeah, there's a couple of different ways to deal with it. So number one, if we're representing a buyer and we see a customer concentration issue, which we would say is either one of two things. One being you have one customer greater than 30% of total revenue, or the second is you have a makeup of the top 3 customers equaling greater than 40% of the total revenue. And so those are kind of those tipping points. Some buyers might be more conservative and have lower thresholds than that, but that's typically where we draw the line that if you're above that point, there needs to be conditional provisions in the deferred portion of the agreement, whether it's a conditional seller note or there's an earnout or a rollover equity, but we make those provisions conditional upon those larger customers transferring.
Let's talk about the revenue mix, not from a customer standpoint, but from a product standpoint.
Yeah, so we'd say a best-in-class MSP or managed service provider is over 75% recurring revenue. We've even seen some private equity groups say you're not actually an MSP if you're below 60% in recurring revenue. And we define recurring revenue as contractually obligated to pay monthly recurring revenue. And so, technically, if you were on a month-to-month contract or you had month-to-month contracts with your customers, we wouldn't call that contractually recurring because they can cancel at any time. So therefore, we're talking these minimum of annual agreements. And in some cases, we've seen 2, 3, or as the longest I've seen is a 10-year agreement with a customer. But then that gets into a whole other risk factor on the contract side that you want to make sure there's provisions to increase that rate and there's flexibility in the contract and transferability and whatnot.
Yeah.
But when we're looking at that revenue mix, not only is recurring important, but there's a gross margin component that's tied to each of those different revenue streams, as you mentioned, that the market as a whole is willing to pay as high as 55 or even 60% gross margin in some cases on managed services versus projects, break, fix, recurring software type of revenue streams. You're maybe at most 45 to 50%, maybe on the projects, break, fix side of things, probably more in the 35% range for both projects and break, fix, and you're probably closer to 20 to 25% on the software side. And so where the revenue composition, where the rubber really hits the road is when you look at gross margin.
Specialization in any particular vertical, right? We hear a lot about the fact that some guys just get really good at serving a particular vertical and they have a niche in that space. Do you give credit to that? And if so, how?
Yeah, so that again would show up in that recurring revenue mix, at least in our 16 company specific risk factors. Okay. And then within our marketability factors, that would show up as part of the go-to-market strategy and even market prominence in terms of, it does the demographic in which they're trying to market to know of them. And if they are really that keen on that one particular vertical, then that's going to show up in flying colors as a differentiator between them and say another MSP out there. Mm-hmm. And really, it all depends on the vertical. It also depends on how unique you've created that service offering for that particular vertical. It's one thing to say, yep, all my clients are accounting firms. It's another thing to say, I've actually developed a service model that is targeted for accounting firms. Those are two different things. Mm-hmm. And what we've seen is the latter, that targeted approach, that intentionality of the tech stack, the service offering, everything's tailor-made to that clientele group. Those companies sell for nearly a full turn higher EBITDA multiple. There was a great example here in the Twin Cities where I'm based. There was a managed service provider that only did law firms, and they became kind of like the MSP provider for law firms because they had developed their own IP, their own solution that was tailor-made for what attorneys and law firms experience within their kind of technology, tech stack solutions. And they could do it better than anyone else. And so it was like shooting fish in a barrel for them in terms of like, as soon as they got in front of the law firm just immediately knew that was the best solution for them, because not only did they only work with law firms, they had tailor-made their entire approach to improving what law firms were already doing. And they ended up selling for nearly 2 times higher, like 2x greater. So if it would have been a 6x multiple, they got an 8. Not to say that's exactly what they got, but they got 2 turns higher when they did sell to private equity because of that.
What is the number one thing you think, right, an MSP owner can do from a tax standpoint to make their business more efficient?
So I've talked to a lot of owners in the last year, and really it was those conversations that spurred the starting of IT CPA here in the summer. Most of the companies I talked to are structured as S corporations, either directly as they're incorporated as an S corp or they're an LLC that made the S election, and they've been that for their entire existence, 25, 30 years in some cases. and it's never been revisited. But where I see a really big opportunity is where companies are trying to now scale and grow through mergers and acquisitions. In order to compete against the private equity influence in the marketplace, you really need an equity tool or an equity vehicle to be at least at your disposal. Not that you have to utilize it, but you have to at least have the ability to potentially call upon it if that's going to be the deal breaker between you getting an acquisition and you not. And in having that equity tool can also help keep key employees. It can also help you leverage a deal in such a way where you're actually expending less cash flow in the, and maybe instead of doing a seller note, which requires you to have this kind of perpetual, cash flow payment that you have to be paying out to the seller for X number of years. Well, if you do it in rollover equity, now you're essentially deferring the payment to that seller to whoever buys your business down the road. So you essentially move that liability forward to that individual or company or whoever it may be. Now that you're taking on when you do the note idea, you're taking on the risk. Whereas when you do rollover equity, you're sharing the risk, right? You're maybe limiting some of your upside, but you're at least sharing the risk that you're diluting yourself of that potential downfall. And so what I've been working with companies on is, what about doing an F reorg with your S Corp to become an LLC that can potentially become a partnership if you issued, different units to an acquisition target? What if you converted your S Corp either through an F reorg, subsequent contribution into a C Corp, or even just outright selling your S Corp to a C Corp, and then you just do it in place of a note, and you just do interest-only payments on the note for a period of time? How can you get into a C Corp and then take advantage of the potential benefit that exists under Section 1202 for qualified small business gain exemption and sell that stock of that C Corp greater than 5 years into the future? So there's different opportunities at play that a lot of owners just don't even know about. They just see what private equity is doing in the space, and they're like, well, shoot, how do I compete with that? How do I come to market with a offering from an acquisitional strategy perspective that's attractive? And how do I keep my top talent so they don't get lured away to some sort of key management position in a PE-backed MSP where they can offer that sort of compensation package? Now I can position my business to offer, some sort of, stock options or profits interest or some other equity form of compensation that ties my employees in a little bit tighter, and then also makes acquisitions a little bit easier.
Yeah. Companies I talk to who come to us and express an interest in a sale tend to have a 0 to 3 year horizon in their mind. Either they're ready to sell today, or they say we want to make a few changes, but it'll take about 2 years or maybe 3 years to do it. But we know that for a C Corp to be effective from a tax standpoint, you need to be out there for 5 years to do this. So what I find odd is that C Corp structure, if they haven't already put it into place, falls outside that 3 year horizon, where they're planning to exit. Does that mean that for these folks who are in that 3 year horizon, who haven't gotten themselves a C Corp structure, that they really won't be able to avail of themselves of that advantage, right? And that therefore the S Corp is kind of the way they have to go? Correct.
So that's where you have to look at the fact pattern, and you have to look at the goals and objectives to find out what option makes the most sense. If it's just one owner, well, a partnership's not an option because you don't have a second partner to make it a partnership. So really, S Corp is your best option. But what you could do proactively is you could go through that F reorg and essentially not change your tax filing, not change even the operations of the business. It's merely just a legal change, which now has a brand new S Corp owning the interest of your operating company that's an LLC. Well, now that gives you the ability in the future to offer profits interest or offer some sort of rollover equity in a deal, even if you don't even do it, but at least you're in the structure to do so. So that's like one option to a solo owner.
Great. Absolute pleasure to have you. Thank you so much for your time. Look forward to catching you at one of these conferences, maybe at IT Nation Grow this year.
Likewise. Thank you so much for having me.